So there are some puzzles in the market, specifically stock market. Puzzle means there is no clear-cut answer, or we can't relate the reality with the theory. That's why it seems to be the influence or the presence of a puzzle. So classical finance is always taken by the authors and by the researchers to see what classical finance is explaining or what classical finance is saying regarding this puzzle. But sometimes it is observed that classical finance does not, or neoclassical finance more specifically, does not give the clear or full explanation of the stock market puzzles. So in recent decades, behavioral finance, which has evolved, so behavioral finance is nowadays has been taken by the researchers to explain the observed stock market puzzles. So I will mention about which puzzles we will be discussing in today's session. So in previous classes, we tried to explain how or why particular stock prices can go in different direction, explained or expected by the rational pricing. So we try to explain that for these biases, this stock might become overvalued or this stock might become undervalued. We try to explain from the micro perspective. So if we think from the market perspective, or we think that why all of these stocks are going up or why all of these stocks are going down, or why in aggregate the market is going up or why in aggregate the market is going down, we can also relate the behavioral issues we introduced in explaining the movement of a particular stock. So when we are interested to the aggregate movement of the market, in that case, we try to explain from the macro perspective. So behavioral finance has two perspectives. One is from micro perspective, another is from macro perspective. So today's session will be more for macro perspective. So some market puzzles, we will try to get the concept first. Then we will try to explain that what are the behavioral issues we can take help for explaining those puzzles. So one puzzle that is commonly cited across the finance text and most commonly discussed puzzle, because it is very much related to the very foundational concepts of finance, that is the equity premium puzzle. So you are much familiar with the risk premium. You have learned that stock market investment is riskier relative to the investment in fixed market, fixed income market. That's why as long as investors are taking higher risk by investing in stock market, that's why investors should be compensated by a risk premium. So you probably, I believe that you all have learned this fundamental issue from your finance classes. So the thing is that, okay, fine, the investors will get risk premium, and that is here equity premium in other word. But the question is how much equity premium investors should claim, or investors should be happy with how much risk premium investors should be happy. So that is a big question. But is there any way by which investors can explain that I will be happy with this amount of risk premium? Obviously, there is an answer to this question. You can relate with very beginning content of this course. You probably can recall we discussed about the utility concept. So from the utility concept, we learned about the certainty equivalent. We learned about the difference between the expected payoff and the certainty equivalent is for the compensation of the risk, or in other words, risk premium. So that indicates that also gives us answer how much risk aversion individual exhibit and how much risk premium is appropriate based on the risk aversion parameter of investor. If the risk aversion parameter measurement is higher for a particular investor, that investor should be given higher risk premium. And if it is found that investor is a kind of someone who wants to have more tolerance for the risk, and in that case, his or her risk aversion parameter value will be lower. And that's why you can make that investor happy by providing less risk premium. So these are some common discussion. So it has been found that the risk premium or the equity premium, which can be estimated based on the risk aversion attitude of the investors, is much lower compared to the equity risk premium which is given in the real market. So there's a big difference. There is a significant difference between the risk premium to be given to the investors based on his or her risk aversion parameter and the risk premium which is available from the investment in the stock market. And it has been found that this is much higher. This gap is much higher, and the risk premium available in the market is much higher than the risk premium which is rationally expected. So that's why it is known as equity premium puzzle. So we will be interested to explore the reason why there is a gap between these two risk premium. Not two risk premium, one is the expected, another one is the actual. Why there is a big gap? What are the reason? Is there the plausible reason from classical finance? And if the classical finance is classical finance does not give the full explanation or does not give the convincing explanation, do we have help, or do we have explanation from the behavioral finance? So we'll try to see it later. Then second one, that is also a puzzle, that is the bubble, with which you are much familiar because it is commonly cited in the financial newspaper. So we see the formation of bubble and the burst of bubble on a cyclical basis. So by bubble, we try to mean when we see that market is moving at a very distant way from the fundamentals, and the market price movement or the market index movement, when it cannot be connected, or when it cannot be related, or when it cannot be explained by the fundamental changes I mean the company earnings changes, company investment changes, these things, and the valuation changes. In that case, we try to explain this kind of situation that bubble is going to form. And when we see that bubble starts to disappear, bubble starts to burst, we mean that we are approaching to a period when the bubble will not be there and bubble has started to burst. And the third puzzle, we will try to see the answer, that is the excess volatility. So volatility is the characteristic of any investment. And when the volatility is higher, we try to explain that that investment is much riskier related to another investment which has less volatility. So obviously, stock market investment is a riskier investment and it should have volatility in its return. There are so many models in the finance by which we can model the volatility, or we can forecast the volatility, how much volatility will arrive or how much volatility will be faced by the investors in coming days. There are a number of forecasting models. So it has been found that the volatility which can be estimated based on the fundamental model for stock valuation is not the volatility which is observed in the market. So based on the future cash flows for a stock, a volatility for that stock can be predicted or can be modeled. But it has been found that the actual volatility exhibited by the stock price, by that specific stock price, is much higher than the volatility predicted. So there's a good amount of dispersion. So this dispersion is known as the excess volatility. So this excess volatility, in other words, has been explained as for the reason irrational exuberance used by Robert Shiller. Robert Shiller has mentioned that irrational exuberance of investors is the reason for experiencing excess volatility in the market. So we'll try to discuss these puzzles in our next discussion. The first one is equity premium puzzle. So from the very preliminary concept, it is almost clear that what we try to mean by the risk premium or the equity premium. So to get the idea that how equity premium is calculated or how expected equity premium is estimated, you need to, or we need to know that how the return in the stock market, or how expected equity return, or how expected fixed income return is estimated. So usually we look at the history, and based on the historical return, we try to develop our expected return. And we also develop some, or we also have some model, which is CAPM and also Pharma Friends 3 factors model to estimate the expected expected return. And expected return has one component, that is the expected risk premium. So you have, we are seeing a graph which is giving answer to the question, that is, if anyone invest $1 in 1802. Note that the initial point is 1802 year. I mean 1802 year. Right now we are in 2021, and we are now talking about the year which was 1802 or 1802. So the question which was asked by Siegel, the author, that if any investor invested in $1 in 1802 year to in gold market or in government treasury bill and or corporate bond or the stock market, how much he would have after almost close to 100 years, but that is the 1997. I mean, in 1997, how much would the investment of $1 in 1802 year would give to an investor? So it has been found that is interesting, that if I would invest $1 in 1802, I would invest $1 in a stock market. I would have $7.47 million in 1997. So this is a staggering figure. At the same time, if I would invest in the bond market instead of investing in the stock market, for $1 investment in 1802, I would have only 10,744 in 1997. Then, if I were more risk averse, not investing in bond also, I invested in government bills, how much I would have for the same $1 investment? The answer is I would have $3,879. Now I am much risk averse. That's why I didn't invest even in government bill. Rather, I purchased $1 of gold in 1802 year. So how much I would have for this investment after, I mean, in the 1997 year? The answer is I would have only $11.17. Now you already have started asking the question in your mind that by this time, by this long period of time, there has been significant changes in the inflation. So this nominal changes in value, or also the nominal return, which is apparent from the figures, might not be very attractive if we would consider the inflation and we would consider the return in real term. So for solving that confusion, inflation has been adjusted in this graph. Now you are seeing the real changes in price after adjustment of inflation in real term. So we see after adjusting for the inflation, Now, the investment in $1, investment of $1 in the stock market yields how much in real term? What happened to the $1 price of a stock? $1 investment in a stock market in 1802 has reached to how much in 1997? I'm asking question. $1 investment in a stock market reached to which value in 1997?
Sir, it became 5,58,946.
558,946. Okay, fine. So compared to the nominal value, it is much lower, right? Compared to the nominal value, which we are mentioning in the previous graph, this is much lower. But still, we are seeing that a stock market dominated, or a stock market investment dominated investment in all other markets. At the same time, $1 investment in bond reached to $803. $1 investment in bills reached to $275. And $1 investment in the gold reduced to $0.84. Still, we love gold. In terms of the nominal, I mean, when we consider the real term, the gold value has declined to 0.84, which is less than my investment. Okay.
Yes,
Then,
sir.
if I wouldn't make any investment, if I didn't make any investment of $1 in 1802, because I fear investment. Investment is a riskier activity. So it's better to keep the $1 under my mattress instead of inviting risk for myself. In that case, what would happen of $1 investment in 1802? What would happen in 1997? It would become,
It will lose value because of time value.
it would become 7 cents. Okay. So investment is rewarding, but out of this investment, you are looking which investment is most rewarding in a very plain language, without talking about other complexities of investment. Which investment is most rewarding?
Stocks.
Stock investment is most rewarding. It has been, and now it is time to look at the return. I mean, we just have seen the movement of $1 across the time period, across the years. Now it is the time to translate the changes in the price to the return, which will be more easier to compare the this investment, and also to compare the return across the period. So let's have a look on the return. So this is the full period with which we are interested. 1802 to 1997. How many years here? 99 years. How many years are here?
189.
Yeah. 189 years.
95.
How many years are here?
195, sir.
195 years. Okay, let me write it for you. $195. So it is equal to 3 times of the life expectancy of average individual. Is the kind of we are talking about investment made by 3 generations. Okay, in rough figure. Okay. How much periods are here? How many years? From 1802 to 1817.
68.
68.
So it is 68. Okay, 64, 68-year period. Then
Sir, 54.
54.
then
71.
okay. These are some subperiods of this 195 years. So the thing is that there are divide and there are also complexities that how we should estimate the return. So very basic average return is estimated either by arithmetic mean or the geometric mean. So when we use the geometric mean for estimating the return, annual return, we see that, remember, these are the real return, not the nominal return. So adjusted for inflation. So for 195 years, this return was 7%. In a stock market investment, we are, for the time being, we are ignoring the arithmetic mean because it has a good number of flaws which make the arithmetic mean challenging to be reliable. And we do not see much variation in the stock market return across the sub period. Is it true? We do not see a very large variation across the sub period. Is it true? Do we see a large variation?
No, sir.
But if we just compare the variation in the bond market investment across the sub period, what do we see? Do we see similar type of variation like a stock market, or we see variation must be higher?
Sir, higher.
Higher. What do we see in the bill investment? I mean the government bill investment. I mean the return. Much higher relative to the variation in the stock market investment return?
Yes, sir.
Okay, fine. Now the question is, the risk premium in a very simple term is estimated by subtracting the return from some fixed income return investment from the return available from the stock market investment. So if we take the very recent sub period, this is very recent sub period, and if we subtract, if we subtract this 2% from the 7.2%. How much risk premium we are investors are getting during this period? Annual. How much risk premium they registered? How much? I have mentioned how it is calculated.
5.2.
I don't listen anything. Have I mentioned how it is calculated, the risk premium?
So 5.2.
5.2. So if we use this period and geometric mean, we see the equity risk premium is how much? 5.2%. Now, if we use the whole year, I mean this long time from 1802 to 1997, how much risk premium investors used to get annually? The same way, just subtract the return from fixed income investment from the investment in a stock market. Return from investment in a stock market. How much? I do not listen any answer.
So 6.5.
How much?
6.5.
6.5. This is the return from a stock market investment, and this is the return from a fixed income investment.
So 3.5.
3.5. Okay, fine. Now, the issue is how much minimum risk premium investors used to get during this long period. I mean, at the same time, you can also calculate from here by subtracting 4.8 from 7. How much it is during this period? 2.2. And how much here? 2.9. Are you with me?
Yes, sir. 2.9.
Okay. Are these very difficult tasks?
No, sir.
These are very simple. Remember what the concept or in which context we are in. Otherwise, you will get confused what we are doing here. Okay. So the puzzle is this equity risk premium, this what we have just have measured, it is much higher than the risk premium estimated by looking at the average risk aversion parameter of the individual investor. So without inviting the mathematical notation for estimating risk aversion and risk aversion risk premium, remember risk premium is indicated by risk premium is usually denoted by gamma. Sorry, risk premium is usually denoted by pi, and risk aversion parameter is denoted by gamma. So just to make yourself introduced with how risk aversion parameter is used in the utility function of individuals. Just to remind you, can you recall that in utility topic, we developed this kind of utility function? Can you recall for the risk averse investor, we developed this kind of utility function? Can you recall?
Yes, sir.
Okay. So, you know it very well. Behind every graph, there is a function. Graph is a representation. Graph is a graphical representation of a function. Behind a graph, there is a mathematical function. So this behind this kind of utility function, there is a mathematical function which can be written in this way. Let me write it here. This is she, which indicates the consumption or the income, these things. 1 minus gamma, then it is divided by 1 minus gamma. So what is this? This is an utility function, utility from this amount of consumption or this amount of return, this amount of payoff. So here this psi, this is the Greek symbol. You would see in the list of Greek symbol, this symbol, and this psi symbol indicates the return, the consumption, the payoff, these things. Now your question is, for having 10% return, how much utility I am getting? So I do not have the right answer, or I do not have the direct answer. So what can I do? I can ask you, what is the risk aversion parameter of you? So without inviting complexities, I'm just giving you some hint. This risk aversion parameter goes up and up for a person who wants to take much risk. Sorry, this risk aversion parameter is higher or goes up and up for a person who is very risk averse. So if I say there are two persons, for person X, gamma is X, and for person Y, gamma is 3. Which person has more risk aversion?
Y.
Y has more risk aversion. In that case, Y will claim more risk premium, or X will claim more risk premium for the same investment?
Sir,
Are you
Y.
getting the things? So Y will claim more risk premium because the risk aversion parameter, which indicates the, or which reflects the tendency of Y to avoid the risk, is higher. That's why Y should have, or Y should be given higher risk premium, because his risk aversion parameter is higher. So I think you have got that how risk premium, how risk aversion, risk premium, utility, these are connected to the equity risk premium discussion we are right now discussing. Okay. So it has been studied that based on the average risk aversion parameter, obviously risk aversion parameter and the utility function differs from person to person. Right now we have 22 participants. So you probably can recall from the very beginning class that we mentioned that each individual has unique utility function. So regardless of the uniqueness of utility function, each of the individual has different type of risk aversion parameter. Some of us have a very higher risk aversion, some of us have a very low risk aversion. So based on the risk aversion parameter, obviously our risk premium expectation will differ. But the question is, there can be an average person, and for that average person, what shall be the risk aversion parameter? What shall be the average risk premium expectation? So it has been found that, or it has been mentioned by the theorists based on the study of utility of individuals, that the risk premium from a stock market investment based on the risk aversion parameter of average individual, it should not be greater than 1%. Maximum it should not be, a maximum it should be 1%, but it should not exceed 1%. It should not exceed 1%. So usually risk aversion parameter, which I mentioned or which I denoted by gamma, don't get frightened by looking at the Greek symbols. These are just mathematical notations. These are just representation. If I would not write this notation, I would have to write I would have to write the gamma in word. Otherwise, without writing the gamma, I would have to write the risk aversion parameter. So for saving these three words, I mentioned the gamma word, and there is a way to denote the gamma by this symbol with the help of Greek people. So don't get hung up with the Greek symbols, just to get the meaning, just to get the insights of the concepts we are discussing on. So we have learned that the psi, gamma, these things which are behind the utility figure we discussed earlier. So we have what is the takeaway from this slide? That risk premium observed in the market is ranges between 2.2% to 5.2% in recent years, but theoretically it should not exceed 1%. On an average, risk aversion parameter of individual ranges between 1 to 3. 1 to 3 of which value? The gamma value, which indicates or which reflects the risk aversion parameter, or which indicates the degree of risk aversion. So does it look like a puzzle when theoretically it is estimated that it should be 1%, but you are seeing that in a real world it is much greater than 1%? Does it seem as a puzzle to you? Because it is much higher. Okay, so this puzzle is equity premium puzzle. Now the question is, okay, the equity premium is higher relative to the model expectation, But the question is why? So before going to answer the question why, we need to look at some cautions for this graph. So what are those caution that is, I mean, also take away that when we are thinking a very long-term horizon, we see that stock market outperform very long horizon. But if we take this horizon, we do not see deviation in the stock market return and the bond market return, and also the return from the government bill. And we also see the same kind of pattern, but in a very long horizon, always the stock market dominate. I mean, the stock market investment return dominate. And if we just say, for example, just look at this this short period. It is not absolutely short period, but relative to the 195 years, it is a very short period. Just to think of, if you would make investment here, what would happen to your wealth after, in this period? I just have asked a question. If you invested your money in this, say 19 before the first, I mean, can you recall the Great Depression? Have you heard about the Great Depression?
Yes, sir.
Yes, sir.
Okay. So, are you aware of the period in which Great Depression, of which period is termed as Great Depression?
1929.
Okay. It lasts for several years. But you see that if you are an investor who invested in a stock market just before the Great Depression starts, you do not know when the Great Depression will start. You just have invested before the Great Depression start. And what would happen to your wealth during this period, which I just have circled, not a circle, but assume that it is a circle.
So the value decrease.
Significantly? I mean, it is not a kind of, what should I say? It is not a kind of this amount, right? You see the slope?
Yes, sir.
It is much higher related to this.
Yes, sir.
Okay. Now, if you just look at this period, this short period, instead of looking at this long period, how would you define the stock market investment? It is much riskier relative to investment in bond market, gold market, which are not much volatile. What
Yes,
would you tell? Stock market investment is an investment in which the risk is highest. You define in this way by looking at this horizon. Yes, no?
Yes, sir.
Okay. But if you look at the long horizon, how would you say that a stock market investment is not as riskier as I considered when I just looked at this short period, right?
Right, sir.
Okay. So the issue is when we see a long horizon, the stock market does not seem much riskier. and it is much less than what is expected. So the reason is that there is a natural thing that is called mean reversion. We probably mentioned it in our earlier class, mean reversion. So it's not like that you will continue to have this kind of return. It is like that it will move and then again it will come down, then again it will go up, then again it will come down. So there is a mean return. So there's a mean return, and when the return is much lower than the mean return, there will be a tendency, or there will be a time when the return will move back to the mean return. And when you see the return is very high, return is much higher than the historical return, than the expected return, and there should be a natural consequence which will cause the high return to collapse to the average return or the mean return. This concept is known as mean aversion, mean reversion. Okay, so we have taken several takeaways from here, but the thing is that we do not have the picture what happened in very recent decade, I mean after 2008. So if you would take the picture and add that picture with this picture, I mean until 2008, you would see that that return which are giving much high return during this period. On 2008, there was a sharp fall from this high return. There was a sharp fall. I mean, although we are indicating the price here, but behind the price, there is a return. So we have not taken that latest picture in our consideration. Now, thing is that as we have learned that there is a much disparity between the theoretical risk premium and the actual risk premium. Remember, we are using the equity premium, risk premium interchangeably. So it has been mentioned that in an economy with reasonable parameter, average return from a stock market investment can be higher than the risk-free rate, or you can compare it with the government bill rate. Average return can be only 0.1% higher. Point how much? 1% higher than the risk-free rate. But how much higher we mentioned or we got here? 3.5%, 2.2%, 2.9%, 5.2%. I mentioned from one source that it can be maximum 1%, but it is not even 1%. It can be 0.1%. Based on some reasonable economic parameter in an economy with reasonable parameter. But we are seeing it is kind of 3.9% in several studies and much higher, say 5.2% in recent years. So now we are curious, why? What is happening here? What is the reason? Only the risk aversion cannot explain this high risk premium, because we mentioned that based on the theoretical expectation, the risk premium can be 0.1% maximum. Why it is happening? Or are we doing any mistake here? So there are a number of explanations. Before looking at some behavioral explanation, Let me introduce an explanation which is also related to neoclassical finance and also related to statistical things. That is the survivorship bias. Survivorship bias. So you'd get this idea and also the issue related to survivorship bias, which has happened here in your from your text. So that is like during this period, I mean in the early 90 early of the 900s. Okay, during that period, it has been mentioned there were 32 stock market. So when the World War I started, in which year? Are you aware of it? When First World War started?
1914.
Hmm?
1914.
1914.
14.
14.
14.
14.
Yes, sir.
Okay, I can't recall it from 1913. Okay. So thank you for reaching us to the First World War starting point. Okay. So for the World War I and also for some economic crash and economic recession, which happened during those period, out of those 32 market, after this incident, only 16 markets survived. How many markets survived out of 32 market? 16 markets
16.
survived, and another 16 markets are closed. Now, when this average index are estimated and also the return are estimated, the 16 market which are closed, which are shut down for the incident, have not been included. Note that why this market are closed? Because they didn't perform well. Investors incurred a significant loss from this market, and this market didn't continue. How many markets continue? Remaining 16 markets continue. Now, if you would consider all these 16 markets which underperformed significantly, what would happen? Your this one, this should move in this way, or this should move in this way. I'm just trying to relate it. It should not be like this. Just try to understand. This should be in this way, instead of having the movement in this way. Have we got it? We have excluded some market which didn't continue, which didn't perform well. We continued this graph with those market which continued. Have you got it?
Got it, sir.
So this is called a survivorship bias. So we are happy with those market which survived well. Okay. So you can also relate it with other average issue. I mean, average issue means we do this kind of problem say, for example, you can also relate it, say in every semester, some people cannot continue because of the underperformance. So if I exclude those students to measure the average performance of the students, what would happen? My average performance would be inflated, would be upward biased. But if I consider the performance of those students which could not continue in this semester, it would be more real. So have you got it? For the survivorship bias, it might be the reason this premium, this premium is much higher. So why this premium is much higher? Because it has been estimated a very high rate. It would be lower if we didn't have the survivorship bias. So it is actually difficult to avoid the survivorship bias, but we have to recognize it after having this calculated. So you have got one explanation why this risk premium can be, why this risk premium or the equity premium is higher. Another thing is like that. Okay, before going to the behavioral explanation for the risk aversion parameter, let me give you the hint that how much risk aversion parameter is justified to rationalize this kind of high risk premium. So remember, what is aversion parameter I assumed? Average 1, 2, 3 for what? Gamma. And you have found that research studies mentioned that the risk premium over the risk-free rate should not exceed how much? 0.1%. Now we are finding that risk premium is, say for example, risk premium is here. I'm taking this. Okay, I'm taking this for example, say 3.5%. Now my question is, remember this 0.1% can be justified by how much risk aversion parameter? On an average from 1 to 3. Now the question is, if the risk aversion parameter is 3.5%, how much risk aversion parameter is justifiable? The answer is, it is said that risk aversion parameter should be as high as 30, which is very unusual. The gamma value should be 30. The gamma value should be 30. Now let me show you some maths which is connected to this one, which I mentioned earlier. Here, I mean the utility function. She to the power 1 minus gamma divided by 1 minus gamma. Based on this, we can estimate the utility, and also it is possible to measure the certainty equivalent risk aversion using this utility. So certainty equivalent, you can probably recall the certainty equivalent concept. So certainty equivalent can be measured by this way: 1 minus gamma multiplied by utility to the power 1 by 1 minus gamma. Just try to understand what we are trying to do. Don't get frightened that whether this will be testable or not testable. Okay, so this is certainty equivalent. Remember what is certainty equivalent? We discussed certainty equivalent is that amount of wealth from which we get the same amount of utility which is available from the expected wealth from the some expected wealth from an event where we are not certain that which wealth we are wanting or we are expecting to get. So you let me relate an example so that it will be more clear to you what we are discussing. Okay, are you seeing my Excel? Are you seeing an Excel sheet?
Yes, sir.
Okay. So the issue is like this, that you have you want to get, you have two wealth you are expecting to receive. I mean, you have two payoff from one particular event or one asset. Okay, this much is triggering. It will be better to express the number in the exponent. Okay, so you have two payoff. Say this one, say we are defining this is x1 and this is x2. So one payoff is 50,000, another payoff is 100,000. So for the first payoff, you have the probability 50%, and for the second payoff, you have the probability 50%. So how much payoff is expected? What is the expected payoff? From the information I just have shared. It is very simple. Sum of the multiplication of probability associated with probabilities and the payoff. What is that value? This one, 0.5 multiplied by 50,000 plus 0.5 multiplied by 100,000. 75,000 is the expected payoff, right? You're very familiar with this kind of calculation. Expected payoff.
Yes, sir.
Okay. Okay. Okay, fine. Now, in that way, can we estimate the expected utility? Is it possible to estimate the expected utility? You have to say yes or no. If I can calculate the expected payoff, it is also possible to calculate the expected utility if I have the utility number, utility function. Okay. So let me relate it with you. What kind of utility function I wrote earlier? So I wrote earlier the utility function in this way, that is known as Clara utility function, which is constant relative risk aversion. So how this look like? that is oh, it's not the right way of okay. One minus gamma divided by 1 minus gamma. Okay. Now, here for the first payoff, what should be the psi value? 50,000. And here, 1 minus 30. Why I am writing gamma equal to 30? Where I have mentioned gamma is equal to 30, for what reason I have mentioned 30? Can you recall? I just have mentioned few minutes ago. To justify the very high risk premium, 3.5%, 4%, 5%, which is observed in the market, very high equity premium, the gamma should be at least 30. But if the risk premium is say 0.1%, gamma is closer to 1 to 3. Have you got it? Why I have written gamma is equal to 30 to justify this? Is it now clear to you? Is it now okay why I have written gamma is equal to 30 instead of 1, 2, or 3? I have written 30.
Yes, sir.
Okay, now what should I write in the denominator? 1 minus 30. In this way, can I get a value which indicates the utility from 50,000 payoff? Can you get this calculation? So what can we do? We can use an Excel, and in that way, I have estimated this utility. Have you got it from where this calculation, this value has come? Okay. In the same way, I have calculated the utility from 100 taka payoff. Is it clear to you how this utility has come? Are you getting worried?
Yes, sir.
For what reason?
It seems a little bit difficult, sir, but it will be clear after I review the class later.
Okay. It is not for making you worried. It's just for making you clear these things, and just to make you not to get worried that these things will not be testable. You get more worried when you believe that these things will be testable. Okay, just believe that this will not be testable, but it will be much helpful for you to understand these things. Okay, now we have the utility for each individual payoff for 50,000 and for 100,000, and you see I can estimate the expected utility. You see, I just have multiplied the associated probability with the respective utility. So this is my expected utility. So from this expected utility, what can I do? I can, this value is how much? This value is my, this is a kind of exponent because it is a very low value, very low value. So remember, absolute value of utility does not say anything to you. However, if you go for comparing the utility from this payoff for the same individual with the payoff from another asset for the same individual, then it will give you some meaningful answer. Okay, that is the characteristic of utility function. Okay, so now thing is that from this utility, can we estimate the certainty equivalent? So remember, expected wealth is 75,000. Okay. Now, in the Crara utility function, where gamma is not equal to 1, I mean the risk aversion parameter is not equal to 1. In that case, we can use this utility function for Crara utility function, constant relative risk aversion. Okay. Now, at the same way, we can also estimate the certainty equivalent, but how? That is the 1 minus gamma multiplied by the utility to the power 1 by 1 minus gamma. This is for what? This is for estimating the certainty equivalent. What is certainty equivalent? Certainty equivalent is that amount of wealth from which I get the same amount of utility which is available from the expected wealth. So you see the expected wealth, the expected wealth is 75,000. From this expected wealth, this is the expected wealth. This is my expected utility. Let me write it for you so that it will be clear to you. So what can I do also? I can estimate the certainty equivalent. So by using this formula, what I just have written here, I have calculated it. Certainty equivalent. How much is certainty equivalent? 51,209. Remember, this is in dollar value. 51,209. Okay. So you see, for an asset in which there is a 50% probability of getting 50,000, there is a 50% probability of getting 100,000, where the expected payoff is 75,000. A very highly risk averse individual of whom the risk aversion parameter is 30, he would get the same amount of utility only if he receives $51,209.48. So this is much higher. This is much higher. So 51,209.48. Let me show you it in graphical form so that you will be less worried. This is our horizontal axis. Here I am writing the first payoff, that is the 50,000. And here we have the second payoff, that is the 100,000. And for 50,000, I get an utility. As the amount is very meager, let me write it, let me denote it arbitrarily, say in this way, because I'm a very risk averse individual. That's why I get much higher utility when I get the expected wealth. Certainly say that expected wealth is 75,000. Remember, this is my expected wealth. So I get much higher utility. It is the utility I would get, but as I get much higher utility for the same expected wealth when I get it certainly, in that case, my utility curve should be like this. So it is not my utility curve. My utility curve should be like this. Remember, it is a kind of concave shaped utility curve. For poor drawing, it looks like a straight line. Okay, it's a kind of concave shape. Okay, so you have got it. So let me relate it with the expected utility here. and also the utility and also the expected utility. So we have mentioned that it is the expected wealth from, it is the expected wealth, and if I get it certain, I will have this amount of utility, and certainty equivalent is that amount of wealth. I'm not connecting the line, 51,209. I would get the same amount of utility from the 51,209, which is certainty equivalent. That amount of utility which is available from the expected 75,000 utility. So if I get the 75,000, remember, if I get the 75,000, the utility would be here, but as I would get it certainly, the utility is here. So this is the certainty equivalent amount of wealth, and this is the expected wealth. So as long as I have the same utility from these two amounts, I would be indifferent between these two, from 51,209 and 75,000. Now, if anyone gives me offer that I will give you 52,000, will you go for playing the gamble, which will give you 50,000 in this estate and 100,000 in this estate, and of which the expected payoff is 75,000? Will you play the gamble? The answer is no, because I'm getting 52,000, which is giving me higher utility relative to the utility which I would get from the expected wealth and also from the certainty equivalent amount of wealth. Remember, certainty equivalent amount of wealth and the expected amount of wealth give you the same amount of utility. That's why this is certainty equivalent amount of wealth is much attractive to the individual who is risk averse. So the takeaway is that 51,209 certainty equivalent is relatively a very high figure or high amount for the average individual, and 51,209 certainty equivalent is only available when the risk aversion parameter of an individual or the gamma is equal to 30, which is much higher. So what can you do? You can take these numbers and relate it what we learned in the utility concept in very earlier classes, so that you can enrich your learning on that. So these are relatable. All these are relatable. So I am returning to our discussion on the equity premium, and we will try to see that what are the behavioral explanation for the high equity premium. Are you seeing my PowerPoint screen?
Yes, sir.
Yes, sir.
Okay. So can you recall the prospect theory concept, the very basic foundation of behavioral finance, what we have learned?
Yes, sir.
Okay. Investors are likely to hate the same amount of loss, and their hate is much higher relative to the pleasure they get from the same amount of gain. So they have a loss aversion tendency. So one justification for high equity premium is that the high equity premium of stock market investment can be justified as a compensation to the investor for the loss aversion. And I also relate it with some other biases, but related that because individuals are likely to avoid loss, and they are very unlikely to incur. They are very unlikely to make investment in a stock market for having the loss aversion bias. That's why the high equity premium is a kind of compensation to the investors to invest in the stock market. So this is kind of one explanation. Another explanation is that there is a mental accounting issue. Mental accounting concept is a kind of thing that when there is a single piece of information, but individuals are likely to consider that information into in some classified manner. That's why they do not think in aggregate way, or they do not think the information in aggregate way. They do not consider it a single information. So what actually happened, sometimes they are not very serious, or they are not very intelligent to evaluate their portfolio. So what happened when they see there is a loss in their portfolio very short time, or they generate or they see that there is a gain in their portfolio in a short term, they do not take it seriously. This is one thought. Another thought is that individual investors are too much intelligent and too much serious on their investment, and what they do when they see they are incurring loss in a certain period, instead of waiting, they go for booking the loss, or they go for incurring the loss. So that is another way. So these are this happen how people or how individual evaluates the information which has been made available to them by their brokerage firms, how they are looking at the information. So we already have mentioned earlier that when you look at your portfolio within a very short horizon, say one day, every day, you look at your portfolio statement and you see, wow, I have this amount of gain. Again, on after one day, you see, say for example, your portfolio is showing 20,000 taka loss. You see, you mentioned that, oh, it was my mistake of making investment in the stock market. I should not do it again. It is for this event, this incident happened in a very short interval. I mean, for one day, 1 month. But if you look at your portfolio, say 2 years or 3 years, your conclusion would be different. But it has been found that investors have a very short horizon perspective. That's why they feel it very strongly when they see that their portfolio is generating loss, although for a short horizon. So actually the issue is that loss is loss only when the loss is registered for your investment horizon. Say for example, let me make it clear to you that you are right now in year 30. So you have made an account for your retirement. and that account will be investing in the stock market. So you are expecting to retire on the year in which you will be 60. So you have investment horizon of 30 years. You have investment horizon of 30 years. So you should not be worried if you see that after 5 years, you are in a loss of say 500,000. You should not be worried. You should only be worried if you see that on 30 years when your investment will be closed. I mean, say for example, 2051 from this year, I mean, after 30 years, when you see that your investment is now giving you loss of 500,000, then it is matter. So you should consider that as long as your investment horizon is going on, you should not be worried for the loss which is happening in the short interval in your investment horizon period. In that case, it is okay. But investors, though they have the investment horizon for 30 years, it has been found that investors are very much worried after seeing the loss in 1 year interval. And it is not only for the retail investors, and it is also for the sophisticated asset managers. They get worried when they see that they incurred loss in last 6 months. They do not see that I have 10 more years to continue this investment. So this type of behavior of the investors are termed as myopic loss aversion. So myopic here, it means investors are very short-sighted. They are very worried by seeing their or by evaluating their portfolio in a very short horizon period. So what kind of risk premium? I mean, how can we justify the high risk premium? We can justify the high risk premium by explaining this kind of attitude of investors. That's why they expect high risk premium. And another explanation that is to be related, that is the ambiguity aversion. Ambiguity aversion, you probably can recall from your earlier lecture. Ambiguity aversion. So between two boxes, just for example, between two boxes in which the distribution, say for a red ball and white ball, is known to you, but the distribution of this box, but the same number of balls total is also in this box, but you have not been given the information that how much is red ball, how much is white ball, but you have been given information for this box, how much is red ball, how much is white ball. In that case, individuals are very likely to overestimate the probability for this box and ignore this box, and underestimate the probability of picking a ball in this box. So this is kind of ambiguity aversion. So say for example, you know that you are much familiar, is a kind of also related to familiarity, and just the opposite of familiarity is a kind of ambiguity aversion. So if I ask you to make investment in North Korea market and Indian market, which one is more likely that you will be making investment in North Korea market or in the Indian market?
Indian market.
So the reason is that you believe that you have more ambiguity with the North Korea market relative to the ambiguity you also have with the Indian market. You believe that Indian market is more familiar with you. So because of the ambiguity aversion, which is very much common in the stock market investment, because you do not know how much dividend is company is going to declare, how much cash flow company is going to have in coming years, you do not know anything. You have to expect, or you have to forecast many things relative to the investment in other assets. So that's why it is mentioned that high equity premium is a compensation for the individual investors who are not only the risk averse, they are also the ambiguity averse. So that's why if I give the compensation to the investor for incurring the ambiguity, then investors will be agreed to make investment in the stock market. So high equity premium is not only for the risk aversion, it is also for the ambiguity aversion attitude, behavioral of individuals. So this ambiguity aversion comes from the behavioral finance. However, the risk aversion comes from the neoclassical finance. So these are some explanation for high equity premium puzzle. And there is a numerical explanation, numerical illustration for why the equity premium is much higher. But I'm not stressing the numerical example to you because we have skipped the foundational concept of this, I mean the prospect theory in the chapter 3. So that's why I'm skipping this numerical example. However, I would encourage you to go for it and to look at it if you have time and if you have interest, and that will be interesting to you with our discussion on prospect theory and also our discussion on the expected utility concept. And on that note, I would like to take a 10 minutes break, and we will resume our session at 9:10 p.m. with two remaining puzzle. One is experimental puzzle and another one is excess volatility. Okay, so we are pausing the session now. Okay, we can resume our session. You are there?
Yes, sir.
Okay, now we like to concentrate on why the bubbles form in the stock market, and the finance theorist tried for several times to explain what are the reasons behind the formation of bubble. Sometimes some explanations are plausible, sometimes some explanations are not plausible. So we will also try to see some explanation from behavioral finance why the bubbles form in the market. And you are much familiar with the bubble, and some facts are bubbles are very wonderful to see, and many people, including the sophisticated investors, also sometimes are very eager to ride on the bubble. But when the bubble burst, many people and many investors lose their wealth, and not accepting the sophisticated investors. But some prudent investors can avoid bubble, and also they do not make their portfolio jeopardized for the period when bubble forms, and they also do not incur losses when the bubble burst. So we have history of a number of bubbles in the global market. So one of the bubbles which is much prominent, that is the tech bubble, on which we made discussion in previous class, which is also known as the dot-com bubble, which happened in the late 1990s, and in worst it got worst in it following decade. And recent experience of the bubble in global market is stressed from the 2008, and which burst in August 2008. So we like to see that why bubble is formed in the market. And when bubble is formed, we see that the stock market index is in a historically highest position and the record position, which is very rare to see. So it is always interesting to know what are the reasons or what are the indications that how the investors are approaching, or how the market is approaching to the bubble. So it is interesting and also essential to know, because the people who would like to avoid the bubble, they can make themselves aware before the formation of the bubble. So it has also been found that a hedge fund, who are most sophisticated investors known to the market, they also rode on the bubble which happened for the tech market. So let's continue. It has in an experimental design, though this kind of design is not appropriate, not fully explanatory for understanding the bubble, but it might give you some basic insight that how bubble is formed. So let's assume a particular asset on which the dividend, which is representative of cash flow, is available, and this dividend is earned on the units of asset, and there is a trading period. The trading period can be 1 hour, trading period can be 5 minutes, trading period can be 1 month. So in each of the trading period, there is a probabilistic distribution of the cash flow to be received from that asset. So we do not know certainly before the declaration of the cash flow or the dividend that what is the dividend for this period. But what we do some estimation of the expected dividend based on historical estimation, changes in firm's condition, then our outlook for that company in this way. So what we do, we estimate the risk neutral probabilities. So risk neutral probabilities is the probability which accounts for the risk associated with that cash flow or associated with the payoff. That probability is risk neutral probability. So what can we do? We can estimate a fundamental valuation for asset by estimating the present value of all the dividend to be received from that asset in all periods or in all of our investment periods. So remember, we mentioned that bubble is something which is observed when the market price of asset is in a level which is very, very far from the fundamental level, and it cannot be justified by the fundamental valuation. And then we try to believe that bubble has been invited by the investors in that stock. So let's assume that we have 12 periods. We have 12 periods. In each period, we have 12 trading period. In each period, we have a probabilistic expectation for the dividend. Remember, the probabilities, these are risk neutral probabilities, so that we do not need to have a requirement of discounting, not the discounting, I mean the adjusting for the interest rate anymore, because we have adjusted our probabilities for risk. So we are right now discussing about an standard asset. So that standard asset, we are expecting that for a certain time period, trading period, that asset will give us 50-cent dividend with 48% risk neutral probability, and so on. 90 for 48% probability and $1.2 for with 4% probability. So if we take a probabilistic, I mean the expected dividend for a period, we would get 0.72 for one single period. So if we assume that we will be holding this investment for 12 periods, and we have this kind of expectation for each of these 12 periods, what can we do? We can multiply the expected value of dividend in a single period and multiply it by 12 holding period. So the fundamental value in current period or in the beginning of this period will be 8.64. So if we are risk neutral and we do not have the sophisticated technology, or we are not very much skilled to look at each ins and out of this company's cash flow, and we are not very much skilled, we do not have much knowledge, how much maximum price we are expecting to pay for this asset? 8.64. We do not know much about. You might challenge this expectation that dividend discount model is not all the things which will tell you about the fundamental value. But for this constrained scenario, we are assuming that we do not have much information. We just have the information of expected dividend. So based on our estimation, we will not be prepared to pay more than 8.64 for this standard asset of which we are talking about. Are you there with me?
Yes, sir.
Okay. Now, what is the, this is the 8.64 is here. I mean, in the period 1. So note that this asset will also be non-exist after the 12 periods. So what is going to happen over time when each of the periods dividend will be given? Over time, this asset price fundamental value will come down at a constant rate. Very simplistic assumption. Are you getting the things? Fundamental value will go down over time. When the dividend of each period will be given. You see, when we are here, we only have 11 periods dividend remaining. When we are here, we have 10 periods dividend remaining. When we are here, we have 9 periods dividend remaining in this way. Okay, and when we are here, we have 1 period dividend remaining. Okay, are you getting the things? How fundamental value is approaching to the final period?
Yes, sir.
Okay. Now, this is for the solid line, solid gray line, which is indicating the fundamental value. Now, some representation of the bubble market have been taken, 4 representation, median 1, median 2, median 3, median 4, have been taken to compare how the market value in bubble market move in comparison to the fundamental value. Okay, so now you see in the period 1, I mean in this period, period 1, out of the 4 bubble market, 2 markets are estimating lower price than the fundamental. This is our fundamental pricing here. 2 markets are estimating price which is lower than the fundamental. In the period 1. Are you getting the things?
Yes, sir.
Okay. What about other 2 bubble market? One bubble market has estimated the market price which is very close or in line with the fundamental pricing. Another bubble market has estimated the price of this stock, I mean the standard asset, which is above the fundamental pricing. It is the story of period 1. And what about the period 2? You see, all of the bubble markets are estimating the value which is above the fundamental value. Same thing happened in the period 3, same thing happened in the period 4 and period 5, period 6, period 7, period 8, period 9, period 10. What happened in period 11? Two bubble market reached to the pricing which is expected by the fundamental, and two bubble market are yet to reach to the fundamental. But when we are at the closer, I mean in the closing, what happened? All are approaching to the fundamental. All bubble markets are approaching, are now very nearer to the fundamental valuation. But what happened during this period? During this period, bubbles were formed because they expected the valuation is much higher than what is justified by the fundamentals. So you look for the explanation why they expected like this. But I believe that you have understood the graph, that how the bubbles approach to the bubble start in the very starting period. Bubble market estimate the price which is below the fundamental, and in the mean time period, bubbles formed. However, at the ending of the period, bubbles burst and all reach to very closer level to the fundamentals. So it is the typically what happened in period 1, fundamental value is above the bubble level. So why the investors estimate price which is lower than the fundamental? Because individuals have a very initially they have a very high risk aversion. So they believe that they have started making investment in a market in which they are not much experienced. However, we have seen that some bubble markets are persistent. Say, for example, this market is much persistent, this one, which burst in a very later period, and also for this market. But however, this bubble market are not persistent. This one and this are not also persistent. This reach to the fundamentals in a very speedy direction. I mean, with a speed related to these two markets. So, though it seems to you that this kind of explanation, that how bubble is formed and how they stay far away from fundamental and how over time they get closer to fundamental, is a kind of look like a simple explanation, but it will give you some basic idea that how bubble is formed and what happened when bubble is burst, and how the real bubbles are generated. But we are more interested to know that why bubble is instigated. What are the reasons? Are there any fundamental reason? Are there any behavioral reason? So one of the reasons which is commonly cited that when short sale is highly restricted, irrational exuberance of investors invite bubble very quickly, because there is no opposite forces which will cool down the bubble or which will counter the formation of the bubble. So in our country, we have failed to introduce the short sale for long years, more than 50 years. You probably are aware that our DSC has aged more than 50 years, but we have failed to introduce short selling in this market. So you need to be aware that this market is very prone to invite bubble because there is no short selling, and short selling counteracts the irrational expectation of the individuals, which lead to the high price of some particular stocks. And there are some behavioral explanation and also for the informational processing, which can be linked with lottery type asset, which we made here, lottery type of asset. So lottery type of asset can be linked with some assets of which the probability of getting a very high payoff is very low, and probability of getting moderate or low payoff is kind of do not exist. So in that case, what happened? Remember, this lottery type of asset has a very high payoff relative to this, you see. So obviously it seems very attractive to you. However, it is very likely that we forget it. The probability is only 4%. So what we do, remember from the prospect theory, in the low horizon of the weighting, and the low horizon of weighting, if it is the real probability, what we do, when the probability, fundamental probability is very low, we estimate very high probability. However, when the probability is very high, we estimate very low probability. This is the weighting function, this one. The curved one is the weighting function, and this is the rational probability assessment. So what people do, where is the people right now for this asset, lottery type of asset, here in this direction, in this area, or in this area? The probability is, say, for example, rational probability is only 4%. But what people are doing, people are estimating probability here. So what would happen? They will be very much confident to pay a higher price for this asset, lottery type of asset. Yes, no? If they estimate that the probability of getting 18 is much higher, but the objective probability is 4%, but they believe that, say, for example, the probability is not 4%, the probability is 40%, what would they do? They will be prepared to pay a higher price for this lottery type of asset.
Yes, sir.
So what would happen then? Then people will invite the bubble for that asset because they have overweighted the small probability. This is one reason. And another reason is that though speculation is sometimes given as a reason for bubble, but it is very less likely to be a reason for bubble. But when for the behavioral biases, investors are interested to pay more for a lottery type of asset by taking a higher risk, which is above the justified level, which does not conform his or her risk aversion parameter. It causes hitting of the price of that lottery type of asset. That's why you see that for last 1 month and for last 3 months, for some companies on which we do not have much faith, investors do not have much faith, they are giving 900% return, 300% return in last 1 or 3 months. So people are expecting that in our market, in DSC, people, I mean, the investors are, I mean, do not take it as a statement. I'm just sharing my personal opinion. I had a talk with some of the asset managers, and they are expecting that investors are inviting a bubble, which might be formed in the later of 2021, the December 2021. These are some kind of personal opinion from some people, but this might vary. But we need to be aware, because I am also an investor in this market. You are also an investor in the market. So the suggestion or the takeaway from our lesson is that do not hang up or do not go for investing in the lottery type of asset. Stay patient and stick with the fundamental assets on which you have faith, investors have faith, and you have to be much passionate to wait for generating return from your portfolio, and you have to wait for till the ending of your investment horizon and make it confirm that what is your investment horizon. If your investment horizon is 1 month, your investment horizon is 3 months, do not count yourself or do not count yourself as an investor. Investors should have a very long direction. I'm not saying investors should have 100 years direction, 100 years perspective, but at least do not go for making investment like a trader. Trader do not make investment, trader engage in trading. So it is extremely risky. So if you're an investor, always stay in a safe position, because it is always wonderful and happy to see when bubble is forming. And even the hedge fund managers are very eager to ride on the bubble. I'm repeating. However, they are very sophisticated. They can properly time when the bubble will be bursting, so that they know that when it is the timing, when it is the appropriate time to exit the market. However, we retail investors or retail individuals do not know that precisely when the bubble is going to burst. We might have some wide information, but not a specific information. So that is about the learning from the bubble or stock market bubble or experimental bubble market. So we already have mentioned that irrational exuberance, it is the text published by Robert Shiller, who is also the Nobel Prize winner in the behavior, the economics, for his contribution in the behavioral finance, precisely behavioral economics. And it came out in 2000 when the Dow index, the approach to 12,000. And you can also remember that our stock market index, which reached to 8,000 level in the 2011 in the last decade. So it is very likely behavior of the individuals that people forget the things and people do not take lesson from their mistake. So Robert Shiller wanted to explain what is the reason for bubble in the real stock market, real financial market. He used a term irrational exuberance, but I mean the expectation, belief, which cannot be justified by any rational thing. So that is the understanding of irrational exuberance. But I would like to encourage you to go through this text by Robert Shiller, and it is most interesting, and it will keep you stick with that text until you finish the book. And he's a very popular person, and his lecture is very, very soothing to learn and to hear. And it is also interesting. So before going to look at the excess volatility, which was also coined by the Robert Shiller. Okay, what I tried to mention, the irrational exuberance, this term also, though used by Robert Shiller later in his book, but it was used first probably in the 1970s or 1980s. I can't recall the decade exactly, but 1970s or 1980s. Between these two, one should be correct. By the Federal Reserve Governor, he used this term for the first time. So one thing which can be a warning, I mean the warning sign of the formation of the bubble is that when you see the market price earning ratio has reached to a very high level. So you probably can relate some stock market bubble which happened during this period, which has been marked on the graph: 1929, 1901, 1966, 1981, and 2000. And also you can connect with the 2008 here, probably here. So one thing that is common, that price earning ratio reached to a peak level. Price earning ratio not of a particular stock, price earning ratio not of a particular industry, but price earning ratio of the aggregate market reached to a very peak level when the bubble is in its fullest form. So the question is, do we know that it is going to happen here? Do we know when we are here that it is going to reach here? So the answer is that there are some warning signs that it is approaching to a very high level. So what can you do all the time? You can compare it with the long-term interest rate prevailing in the economy in which you belong. And if you see the long-term interest, the PE ratio in the stock market is deviating from the long-term interest rate at a very high percentage. In that case, you need to take it as a warning sign that it is going to be a bubble, and bubble is usually a very short-lived phenomena. It is not a kind of that bubble is going to prevail for 5 years or 10 years. It may last for several months or 1 quarter, like this. So you need to always compare the P ratio with the earnings level or aggregate earnings of the market. And if you see it cannot be justified, in that case, you need to make it, you need to make yourself very aware, and you need to protect your portfolio as early as possible. So it is very difficult to predict precisely. when the P ratio is to be the historically high. So these are some issues which are observed later of the burst of the bubble. It is not something which is forecasted earlier that P ratio will be this level, then the bubble will be burst. So it is very difficult, in fact. So we'd like to conclude our session by having some summary concept on the excess volatility puzzle. We mentioned that in a stock market, the volatility which is really observed is much higher than the volatility which is rationally estimated or rationally expected by using the valuation model. So the thing is that this kind of deviation of the volatility from the fundamental level of volatility expectation has been termed by Shiller in his famous paper as excess volatility. So what Shiller did to forecast the volatility in the stock market. So Shiller, it is from the Shiller's paper. I would encourage you to look at this famous paper, which is "Do Stock Prices Move Too Much to be Justified by Subsequent Changes in Dividend?" So it was published in before 2000, so far I can recall. So what he did, he assumed, or he based on economic fundamentals, he expected a long-term discount rate, long-term growth rate. You are familiar with this, what should I write down here? D1 divided by K minus G. Are you familiar with this valuation model? Very simplest model.
Yes, sir.
Okay. Now, I would encourage you to listen a lecture which is given by the Robert Shiller on the introduction of this model, because why I would encourage you, because we people and we individuals are likely to underestimate the power of simple model, and we overestimate the preciseness of the complicated model. We see a very complicated model, we start to believe that this should be more precise and this should be giving a precise estimation. However, I believe that it happened to you all also when you are familiar with this very simplest concept, which is also very easy to remember for your exam purposes. You immediately started to believe that this is going to be a very flawed type of valuation model. However, note that the companies which are very large, the companies which are very strong, the companies which have a very long history in operation, this kind of constant growth model is very, very appropriate for this kind of companies relative to sophisticated model, complicated model. The complicated models might be more appropriate for the growing company, new company. However, for mature company, this type of model is more appropriate. So this actually happens, this actually arrived in finance from the growth of crops in the land. So there has been increase in the growth of crops in the land at a constant rate every period. So the landowner was trying to estimate how much value my land is worth of if my land gives crops of this amount at a constant rate every year or every harvesting period. So from that history, this valuation model has been taken in finance by applying it into the cash flow provided by the company. So using this model and estimated a long-term growth rate for the market in aggregate by the Robert Shiller, he estimated this dashed price line. You see the dashed line here on which my pointer is moving. You see this dashed line?
Yes, sir.
Which is P star. This price movement was estimated by the Robert Shiller. Based on what model? Based on which model? This model. Based on this constant growth model by assuming a long-term growth rate. Okay. So then what he tried to see that what actually happened in the market. This is the fluctuating line, or the ups and down. That is the real price movement of the market. So which one seems to be more volatile, the P star or the P? Which one seems to be more volatile, P star line or P line?
P line, sir.
P line is much more volatile. That is the actual. So what Shiller tried to see that based on this price line, based on the actual price line, he tried to see how much growth rate. Okay, fine. This is the actual price line. How much growth rate is justified, is rational, or is behind this price line to justify that this price line is okay, this price line is right. He found that this growth rate is very, very higher. I mean, extensively high relative to the G, which can be justified by the economic fundamentals. He mentioned that this is unreasonably high. This is unreasonably high. So remember, when you are expecting, or all investors are expecting, a very high growth rate, obviously this should be realized by the company. It is not like that the investors expected this growth rate, but the company didn't realize. This growth rate in that case is kind of irrational expectation. So he concluded that the growth rate which is to be justified to justify this actual price path was unreasonably high. Unreasonably high means it is not a growth rate which could be expected, or sorry, which could be realized by the companies. So based on this difference in the price movement and the analysis of the model, they concluded that the stock market, stock prices exhibit too much volatility, which cannot be justified by the subsequent changes in their dividend. So that is the concept of excess volatility. And we mentioned about some behavioral explanation, which can also be connected with the excess volatility. So investors expected high or very unreasonably high dividend growth rate, and they also overreact, and they go away from the mean they go away from the mean return. And also investors believe that the recent evidence, the growth rate, dividend growth or the earnings growth declared by the companies in recent years will be continued in the next decade or in the next several decades, which is not rational or which is not justifiable. So this actually happened in individual stock level and also to the market level. So on that note, we like to end our session here. So, okay, this is all about our today's class and also ending of the behavioral finance course. You are much cooperative throughout the session, not only in this session, throughout the semester. And I appreciate your concentration. I didn't try my best, but I tried based on my level. So I hope you will be finding the contents which you learn from this course useful for not for your academic life, but also for your professional life. And it will also be helpful if you want to achieve more and higher education in the behavioral finance, and that is my interest area also. So I would love to see you taking higher education in the behavioral finance and to concentrate on it. But it has been old for several decades. Now the behavioral finance is not a very recent, probably it might be recent, or this is for the first time the behavioral finance is offered in our EMBA program. Still, it has not been offered in our regular program. So that is very unfortunate for us. But we are hoping that we will have a behavioral finance course in our regular program, and we will have more resource person in coming years, and more people will be interested on this course. And on that note, I would like to say thank you to all. And before that, before ending our session, I would like to give you the syllabus for our final exam. I believe that you are waiting for seeing the syllabus for final exam. So let me open the course outline first. Okay, this is our course outline. So we have skipped this content for this term. We have skipped it, but we strongly encourage you to go through this content.
Sir, I don't think you have shared anything.
Okay,
Sir.
okay. Yeah, I forgot it. Thank you. This is here. Now you're watching.
Yes, sir.
Right?
It's
Okay. So I have skipped this content for this term because of our limitation of time. We couldn't devote a session for here, but you will find it easygoing content because of the contents you shared, you learned earlier. And we talked about this in previous class, and today we talked about these contents. This content, do behavioral factors explain market puzzle, and which were the ending of our okay, here we covered this thing in our second meet, and also we covered we devoted 2 sessions for investor sentiment. Remember, investor sentiment has not been followed properly from the text and also from the course outline, but we devoted 2 sessions on investor sentiment. And if you do not find anything in text, I encourage you to go to the lecture and also to other reference textbook I shared earlier. Okay, so what are the contents to be covered in the final term? These 3, you see, these 3 I have highlighted. Okay, let me highlight these 3 first. These 3 will be covered in final. And investor sentiment, for investor sentiment indication, I am highlighting this investor sentiment. I mean, the 2 sessions will be covered. Then overconfidence will be covered in the final session. Final term, overconfidence. Then expected utility theory, which we covered in first meet. And this one, prospect theory framing. Okay, it would be better to highlight for my convenience also. Expected utility theory will be covered. Prospect theory framing, mental accounting will be covered. Then I have mentioned overconfidence will be covered. So these 3 are from first and second midterm, which you already have on which you already have taken preparation, and also the investor sentiment on which on first half you have taken preparation, and these 3. So how many contents we just have highlighted? We have highlighted 7 contents here. Okay. So have you got the contents for midterm? Sorry, final term.
Yes, sir.
Yes, sir.
Okay. So that is all about. I am hoping that you will be in a good health.
Sir,
Yeah.
sir, I have a request, sir, on the behalf of the class, if you may.
Yeah.
Sir,
What
can we
request?
please deduct the first and second lecture you have just assigned for final term? So it will be easier for us if you just
First and
deduct.
second lecture of what?
Sir, you just mentioned, sir, theory lecture 1 and class 1 and class 2 for mid 1.
Okay, let
So it
me
will
open the
be,
slide again.
yes, sir. So it will be easier for us if you just deduct those 2, and the rest of the chapter
Okay,
is okay.
this one.
Sir, yes, sir. Expected utility theory and prospect theory. These 2, sir.
So you'd like to skip this?
Yes, sir. These 2, sir. Please, sir.
Okay, I'm sorry not to accept this request, because these are the foundational concept of behavioral finance. And if I make a question on behavioral finance without having the contents covered from here, that will not justify the question for this course. And also to get the takeaway from this course, I strongly encourage you to review the contents which are foundational concept of behavioral finance.
Okay, sir. You can keep those, but it will be easier if you just did like any 2 chapters from the mid 1 or mid 2. If you just read 2 chapters, sir, from mid 1 and mid 2.
Yeah, I know. I have covered
We have
this
almost
contents.
need to cover around 7 or 8 lectures. If I'm not
Yeah,
wrong.
we need to cover.
Yeah.
These are not new. These are already revised. These have been already revised by you. Okay,
Yes,
just
sir.
for
You're right,
refresher.
sir.
Hmm.
Yeah, it will be, sir, just 1 or 2 chapter. If you, sir, redact, then it will be easier
Okay,
for us. Just 1 or 2 lecture.
to you, these are the chapters. To me, these are not the chapters. To me, these are the foundations on which I will base the course, and I'll base the
Yes,
other
sir.
topics. Okay, I'm sorry to not to take your request for here, but you can remember that I accepted your request in mid 1 and mid 2, right?
Yes, sir.
And just try to understand what is my point. Okay,
Yes, sir. I completely got it,
you'll
sir.
find
sir,
it
thank you, sir.
okay,
Sir,
you'll find it
7
interesting.
chapters
Excuse
will be,
me, sir.
too much,
Excuse me,
sir.
sir. Sir,
I'm listening.
sir, I wanted to tell you something about the assignment that
Sure.
we submitted.
Yeah, I'm listening.
Sir,
can touch.
the timing, the submission time, it was 11:59 a.m. I think you meant 11:59 p.m. So that's why a lot of us submitted late.
Okay.
It showed
Ah.
handed in late when we submitted.
Okay, I got several emails noting these issues. So I would consider for this time, don't get worried for it.
Okay, sir. Thank you, sir.
Any more issue?
Sir, can we have the mark of mid 2?
I didn't check the steps because of so many engagement by this time. I would like to give it to you by next 2 weeks. I mean, before your appearance in the final exam, I am strongly believing that you will get the marks available in your hand.
Okay, sir.
Okay, thank you, sir.
Okay, thank you very much. Take care.
Thank you,
Thank
sir.
you, sir. Thank you for teaching us this very interesting course.
You're welcome. I'm ending the session for all of us. We'll be in touch in Google Classroom, and we'll also be in touch after the finishing of the semester through email. And I also maintain my finance class as a group in Facebook, with which you can also get connected to see the contents relevant for the finance people. And I will try to share the group link with you in Google Classroom. Okay.
Okay,
Stay in
sir. That
touch.
will be very helpful.
Yes, sir. We will surely join.
Anyone wants to say anything?
স্যার যদি ফাইনালে যদি স্যার কিছু স্যার ডিরেক্ট কোশ্চেন করতেন মিড 2 এর মতো তাহলে স্যার খুব ভালো হতো স্যার।
Yes, sir.
Okay, that will be under consideration. That will be a blend of both conceptual and direct question.
আর স্যার ফার্স্ট মিড এন্ড সেকেন্ড মিড
Sorry,
মার্কসের পোরশনটা যদি একটু কম রাখতেন ফাইনাল থেকে, যদি স্যার ফাইনালের পোরশন থেকে যদি মার্কসের ডিস্ট্রিবিউশনটা একটু ওইভাবে যদি করতেন স্যার একটু ভালো হতো স্যার।
the distribution is already given. I mean, the distribution for final marks cannot be changed, right? The distribution for first, second, mid are fixed, and you are aware of it before appearing in the exam.
Sir, আমরা কি ফাইনালে
Sorry, I can't change the distribution. I only have the final exam remaining.
স্যার আমরা কি ফাইনালের কোশ্চেনে একটু আইডিয়া পেতে, কারণ স্যার এখানে সিলেবাস অনেক বেশি, আবার টাইম হচ্ছে স্যার সেম অ্যাজ মিড 1 ঘন্টা।
Yes, the question structure will be like the mid 1 and mid 2, but I believe that there will be no more MCQ questions.
থ্যাংক ইউ স্যার, এই জিনিসটা দরকার ছিল।
Okay, you are welcome. Okay, on that note, let me end the session. Anything else before that? Okay, take care. You also pray for me and for my family. Thank you.
Fair Manil, sir. Assalamu alaikum.
So.